Welcome back to the training on risk appetite. Now, in the previous session, we learned about the concepts and the purpose of risk appetite. And we have compared the risk appetite of a financial institution to the risk appetite of human beings, the influence of social media and of semi-educated experts on the definition of risk and then on the definition of appetite, as well as how the bank should react to that. Now, in the next step, we will look at a couple of definitions in the overall structure of the risk appetite framework. So please enjoy this video. In broad terms, risk appetite is the amount of risk that you as a financial institution is willing to accept in order to achieve the goals. As such, it serves as a management tool. It guides your strategy as well as the risk policies and the limits. It actually provides you some boundaries for your behavior and your decision making. So let's go a little bit broader and include more definitions around the entire concept of risk appetite. Let's start with the first definition of the risk appetite framework. When people talk about the risk appetite framework, they usually refer to policies, procedures, controls, systems through which the entire risk appetite is actually established, it's communicated, it's implemented and monitored. So your overall risk management framework basically relates to your overall risk appetite framework. A good appetite framework outlines the roles and responsibilities for each step in the development, the definition, the review and the monitoring of the risk appetite. Having a risk appetite framework in place is as such already a strong signal that you as an institution are conscious about risk taking. You take risk taking seriously. Ideally, of course, the risk appetite framework is not just present, but really aligns with your institution's strategy. Of course, you can very well argue that the risk appetite should follow the strategy, meaning that the institution should first think about what the business it likes to conduct is about, and then what the overall strategy is before thinking about ways to implement and about the tools to frame risk taking. That's of course perfectly fine, but it still means that risk appetite is part of your strategic development process. Next in the hierarchy, you have the risk appetite statement, and this is indeed, as the name suggests, a very specific written statement in which you list the types of risks that you as a financial institution are willing to accept so that it aligns with your business strategy and with the goal to achieve your objectives. For each risk, there is a qualitative statement and hopefully a quantitative measure with very concrete reference to, for example, earnings, capital, risk, liquidity, and other measures which are used to define your risk appetite. Obviously, there will also be some risk categories that are very difficult to qualify. For example, reputational risks. Here, the risk appetite statement will most likely be very blunt, strictly excluding certain risks. For example, there could be a clear expression in your risk appetite statement that you have no tolerance towards the practices that involve money laundering or other unethical practices. Later in the training, we will work on the development of a specific risk appetite statement. There are just a few more definitions and concepts before we get to that. When we define the absolute levels of risk appetite that we as an institution are willing to have, we first need to look at the risk capacity. The risk capacity is the maximum level of risk that we can take within the framework of the resources that we have in place. At any stage, we need to avoid that certain thresholds are passed. For example, at no stage should there be an excess risk above the regulatory capital limits, liquidity limits, or other operational restrictions. This, of course, relates to the legal framework coming from your regulators, but also to contractual obligations. For example, if you are a financial institution that is borrowing from institutional investors, you will be exposed to covenants. Covenants are set by these outside parties and need to be honored. The risk capacity is the absolute limit. There is no way to exceed these limits, as this would immediately cause a default with a long range of consequences that we really like to avoid. This risk capacity that we just discussed sets the boundaries for your risk appetite. And the risk appetite basically is the aggregate level of types of risks that we as a financial institution are willing to assume. This risk appetite, of course, has to be smaller than the risk capacity in order to allow for some buffers. We also need to make some cross-checks whether the available risk capacity and the risk appetite are actually sufficient to achieve the strategic objectives of the institution as well as the operating goals in the future. For example, you cannot plan an excessive growth of your loan portfolio if today your regulatory capital is already fully deployed. Unless, of course, you will radically change the terms and conditions under which you conduct business and require that every new loan is significantly collateralized by tangible and valuable collateral. Now, below the risk appetite, you will also find the concept of risk limits. Those limits are actually quantitative measures based on forward-looking assumptions that allocate your risk appetite to specific business lines, legal entities, products, risk categories, concentrations, and so on. Here, for example, you can become a little bit creative, especially if you have a sophisticated management system in place. It is possible, for example, to establish limits that are not additive. So, for example, think about lending towards corporates and SMEs driven by your regulatory capital constraints. You can set a limit for your overall loan exposure, and you can split the limit across sectors. Now here, it's still possible that the sum of sector limits is actually exceeding your overall lending limit. And because you like to have some flexibility for the allocation of exposures towards sectors where the business is growing, and you might not be able to fully anticipate the growth in every sector. You just need to make sure that you have the right monitoring tools in place so that you can constrain your business activities if the superior limit, meaning the limits to the overall lending business, is reaching its targets, while you still might have some space under the respective sector limits. Now that we have defined the specific expressions related to the risk appetite, it's time to look at the overall risk profile. The risk profile is the actual exposure, gross as well as net, after any kind of collateral that you as a financial institution have on the books and can be used as a risk mitigator. Obviously, we want to have the risk profile to stay within the risk limits. But particularly when you start developing your risk appetite, it is important to be fully conscious of the actual exposure. And even more if your financial institution is strong in lending exposures. You have to be conscious that your overall risk profile only moves very slowly. Once you have disbursed the loan, there are only very few events that will reduce the risk. For example, the amortization or the repayment at maturity are such events. Without them, your overall portfolio will remain very much static. Therefore, assessing and understanding the risk profile is really an important component of your work in defining the risk appetite. It goes without saying in general, but it's quite often really neglected to my surprise. Another item that is important is that your exposure limits that you're setting actually need to be measurable. Otherwise, they're just bluntly useless. Quantitative limits that cannot be measured are not worth the paper printed on. So, let's summarize this section of the risk framework definitions. We have the risk appetite framework, which covers all the concepts that we're talking about. The risk appetite statement needs to be very concrete with quantitative and qualitative measures. Your overall risk taking is limited by your risk capacity, which is bound by the actual equity capital as well as other limits in place. Your risk appetite optimizes the risks and returns within the framework of your strategic goals. You need to be conscious of your overall risk exposure in place. Your risk limits provide you with the operating plan for the day-to-day measurement of your risk exposure. Please be aware that your risk appetite statement is basically your strategy enabler. It synchronizes with your organization's strategy and objectives, and by that it ensures a consistent approach to risk-taking. The risk appetite is also dynamic in nature. It does evolve with changes in external conditions and with strategic priorities. There is, of course, a fine balance between adjusting the limits every time there is an issue, or on the other hand, becoming too conservative and not adjusting to new market conditions. The right balance has to be figured out by the stakeholders in the risk appetite definitions. Ideally, the risk appetite is somehow a compromise between being overly cautious, which might be limiting the bank's business activities, and being overly aggressive, which can lead to unsustainable risk-taking. And this is something that your stakeholders have to figure out over time, maybe adjusting. Maybe the first framework is just set for half a year, and then later you go to an annual cycle. But it has to be figured out by your institution. And finally, another item that's quite essential, and you might agree it's quite trivial, but still sometimes neglected, is the topic of communication. Your risk appetite needs to be communicated, and this means at every level of the organization. If you're not communicating a risk appetite, you cannot expect that your staff is honoring them. So in the next section of the training, we will look at some of the concepts on how to develop the risk appetite framework and provide some more context on how to link the strategy, the risk, finance, and business. We look forward to see you in the next training and hope you enjoy the training so far. Thank you very much.